Hey, what's going on, guys? My name is Richard Moglen, and today we're going to be doing another Secret to Investing Success video, which is a follow-up to both my stop losses and uptrends video. And the subject that we're going to be covering today is investing in stocks that are hitting new highs. It may seem counterintuitive that you want to purchase stocks at a new high, because you might be thinking that since it's higher than it's ever been, it has to fall down. But that's kind of the wrong way to approach it. What you want to think about is how if a stock is at a new high, it's got no overhead supply holding it back. And this means that it can go on 100, 200, 500% move with very little resistance. When a stock is on a tremendous move like this, it has to continually keep pushing past previous highs. And what I'm going to be showing you in this video is how to use a green line indicator to identify the proper buy point for when to purchase these stocks. The green line indicator was taught to me and developed by Dr. Wish of wishingwealthblog.com, and it's what he uses to guide his trading to make sure that he's focusing on stocks that are on these potentially amazing runs. What Dr. Wish has taught me to do is to identify can slim criteria stocks that have made a new high, paused, and rested for at least 3 months. From this point, you can draw a green line, a horizontal line, at that previous new high. Then you want to wait to enter until the stock has breached that past horizontal line on its way upward. From this point on, after that green line breakout, stocks can dramatically increase in price. Let's jump into TC2000 and I'll show you exactly what I mean. So this is a monthly chart of Apple. So each of these bars here represents 1 month's price data. And to draw a green line, as I said, the stock has to increase, form a new all-time high like here, and then rest for at least 3 months. So that price that it is set right here can't be breached within the next 3 bars. This satisfies the requirements right here, so this is the first green line top. To put this in, I check here and get the high price, which was 61 cents at the very start. Obviously, you'd be very lucky to get into Apple at this point, but I'm just showing you how this method works. And even when the price dramatically increases with Apple and other stocks, this method still works. So we're checking the high price, which is 61 cents. So let's edit this, make it a green horizontal line, and make this 61 cents. Then we continue until the next green line, which isn't here because it's still under the past green line. So right here, it forms a new high right here and rests for at least 3 months. So this is the next green line, and its value is at 70 cents. And let's make it green. Since this is kind of repetitive, I'm going to go ahead and draw in the other lines until we get into about the $20 range. So finally, we're now in the $20, $30 range where a new stock named Apple would finally be on my radar. So you can see that previously it moved up to a new all-time high at this point, but then it consolidated for at least 3 months, actually quite more than that. Each of these bars, remember, is 1 month. So definitely over a year it consolidates, and then finally at this point it breaks through it, and this is the point where you want to start looking for entry points on the weekly and daily charts. And you can see that after this point, Apple increases a cool 700% or so. So you can see that this is incredibly useful, and this is why you need to be focusing on stocks hitting new highs. Because once it breaks through that past resistance point at that previous all-time high, there's no telling how high it can go. So now let's go ahead and analyze a few more recent stocks and see how this method applies to them. And we'll also discuss a couple other things like what to do if a stock breaks through the green line on volume and then falls right back into the base. So first, looking at an extremely popular stock, Roku, you can see that it first formed a green line at this point because this is the first time after the IPO that it formed an all-time high and then rested for at least 3 months. And then at this point, it actually broke through and had a green line breakout, but then it actually formed an all-time high and then rested again for a couple months. And then at this point, earlier this year, it had another green line breakout. So here's how you use this in your actual trading. You can see that if it was back in May and you were looking at Roku as a potential trade and it was finally breaking through its green line, you would want to go to the daily chart and look at exactly what's going on at that point. So you use the monthly chart first to analyze when it's breaking into new high grounds, and then you go on the daily chart and look at what's going on at that moment. And here you've got a breakthrough on earnings, you've got increased volume, so this would be an excellent setup to purchase. And you can see that after this point, it advanced about 77%, which is an excellent gain. And I also want to point out on Roku's chart that right here, Roku attempted to break through the green line, but never quite made it. It met resistance right here from people who bought right here, held all the way here, and then we're finally like, oh, I better sell, I better get at least something for my money. But here on this great earnings report, there are enough buyers to overcome those sellers. And that's what's so important, because right here, it's a fresh bunch of investors. These people are ready to see and ride out Roku until the end. And as we showed from this point on, it almost doubled in price, which is exactly what you're looking for. So Roku is kind of the ideal situation with greenline breakouts. It increased right away and dramatically gained value. But what would happen if it increased on earnings and then fell right back through the green line? What you have to do is sell your position right away, because as we saw right here, when there's a lot of resistance and people want to sell more than other people want to buy, the stock is going to drop or at best go sideways. So at that point, you want to let it consolidate, and if it breaks through again on volume, try to re-enter at that point. But as I said, if a stock has a green line breakout and then falls right back and closes on the daily below that green line, that is a strong sell signal. And to illustrate this point, let's go ahead and look at Canada Goose. So looking at Canada Goose's chart, you can see that I've already drawn in the green line here. So it sets new high ground here and then consolidates for a couple months. And then at this point, it attempts to break through it on increased volume, just like we saw with Roku. But instead of increasing dramatically, doubling, you can see that Canada Goose falls right back here below the green line on actually increased volume as well. And this is a strong sell signal. And you can see that right away it consolidates again, it consolidates, tries to break through again on increased volume, but still meets that same resistance. And then from this point, it closes below the green line right here on this bar. And then right here, it falls 30%. So this is the danger of holding a stock that is experiencing more resistance and can't break through that into new high ground. So just to make it clear again, it is a strong sell signal if a stock breaks through on increased volume, but then drops down below and closes below the green line. That being said, if a stock breaks through that green line on volume and then falls back and closes below it, and you have to sell your position, that doesn't mean that you forget about that stock. Because if it breaks through again on volume, that could be an even stronger push upward. And it could act like HQY here, where after this point where it breaks it initially and falls back and closes below it, and then breaks through again, you can see that after this point, it increased 25%. So keep these failed greenline breakout stocks on your watch list and continue to monitor them. It's also pretty common for a stock to break through the green line and then consolidate above it for a little bit before finally pushing upwards. This is completely fine, and you shouldn't rush to sell the stock just because it pauses and doesn't increase 25% right away. It may take a little bit of time for the stock to consolidate the move through the green line, so it might rest a bit and get rid of all the weak holders before finally moving upwards into new high ground. So make sure you don't sell too early or too rashly for the wrong reasons, or you'll miss out on those 50, 100% moves. And I want to end the video on this last point, which is that just because you missed the initial green line breakout doesn't mean you can't profit from these type of stocks. Take a look at Roku for an example. Even if you didn't enter right here when it burst through the green line on increased volume, doesn't mean you can't profit from this run. There are a couple different great entry points right here, such as the green dot that occurs right here, here, or here. And you can see from this point, you would have made 60% on your money, which is excellent. So the point of this video is to focus your trading on stocks that are at or above their past green line. And this ensures that there's none of that resistance from overhead supply to get in the way of these stock moves. So I hope you guys enjoyed this video, and please leave a like down below if you did, And if you have any questions or comments, leave those down below as well, and I'd be happy to get to them. Thanks so much for watching, and see you guys in future videos.